All right, we're talking insurance, but the modern, very well-marketed version of it. George Tsilis joins us, senior markets correspondent with our overlooked stock of the day is LMND. George, unfortunately, there was some negative marketing around this company since its debut as a publicly traded stock because it was pretty ugly post-COVID. It was sort of one of those early kind of fintech meme trades during the stimulus era, and then went from almost $200 down to a low of $10 last year. So where are we at now?
Yeah, I mean, you're right, OJ. This was one of those, early runners based upon, all the hype around low interest rates and growth stocks that aren't profitable. And so, just to give you context, also, I mean, I went back and looked 7 years. That's the extent of my financial data that I use. And they still haven't been profitable since that 7 year period. So I think it's important in context here. But it's an interesting situation with the insurance industry because LMND is an AI-powered diversified insurance provider. They underwrite policies for like property and theft, insurance, personal liability, rent, home, car, pets, you name it, in life insurance. And the entire industry space is benefited significantly from, I think, two variables. One, interest rates, which have been much higher because insurance companies are required to hold their contingent claims, the cash for contingent claims in treasuries. So they get benefits from higher interest rates. And two, there's been pricing power across the industry space with the insurance rates going up significantly, particularly in the last year or year and a half. After there was a lot of goods inflation, we saw a lot of service inflation, which includes insurance services. So those two factors, I think, have benefited the group. LMND is no exception. I think they've benefited over the past year and a half or so. But if you give context here, or get some context, in the last 3 years, the stock is down still 64%. And in the last 5 years, it's down 86%. So, but they did report earnings this week, and there was another company that is a peer to LMND, Root, symbol ROOT. That stock yesterday, I don't know if you saw it, basically doubled and more than doubled at one point in time and then sold off. So I think there's some element to perhaps some short squeeze going on in the insurance space, maybe in the auto retail space like Carvana, which boomed yesterday, but actually pulled back pretty significantly today. But nonetheless, they did report earnings and they did post some positive results. The adjusted earnings per share losses were expected to be $1.02 negative. They posted 95 cents, which was, slightly worse. That was a loss, slightly worse actually than their last year numbers of 88 cents. But their sales came in better than expected, higher by 19%, 136 million. If you actually look at the breakdown, the premiums in force were higher by 24%. The number of customers in terms of the total count year over year was up 17%. And the other thing that I think caught a lot of attention was the free cash flow metrics, which were pretty significant at 48 million relative to the total sales, and that's 48 million compared to 3 million last year. So the issue is not the issue, but the reason being that the cash flow was so positive is that LMND didn't essentially have the claims payouts during the hurricanes, of which occurred last quarter. So they didn't have to pay out as much, so their loss ratio.
Street thought they were going to get hit on that? And seems like that was the surprise.
Yes, they thought they were going to get much more hit. And so, in essence, they did not. And so that, again, gave that free cash flow boost to the underlying business.
Nice. Okay, so LMND and Root kind of cut from the same cloth, also both very agrarian names for insurance companies, but that's neither here nor there. Root, those candles on Root, though, George. I mean, I don't know, man. These are still pretty high volatility stocks. It seems like there's a lot of these kind of fintech companies that have their niche, and I feel like it's all about getting customers. It's all a race to get customers at like every cost. LMND loses money, right? Like, I think all these companies are currently losing money. Well, but they also could be takeout targets down the road by bigger financial institutions.
They certainly could. And yeah, you're right. And ideally speaking, you have to at least get closer to break even for a takeout. That's just my view, but anything can happen. If you look at the estimates for earnings, Piper Sandler actually has basically a hold rating and a target of $25, so it's not too far off that level right now. But Next year, the company is expected to lose $3.05. Then the following year, 25. I'm sorry, this year $3.05. Next year, $2.50, and then 26. I have $1.78 of a loss. But one of the things that the CEO denoted, or the CFO in the conference call that I read, they said they were looking to become adjusted profitable in 2026. So I think there's a little bit of a discrepancy between the consensus prior to earnings, which is a loss of $1.78, versus what was guided by the executives of the company. So I think the other thing is the short interest on the stock, plus the market cap being low, about 1.7 billion, with short interest about 22%, created a lot of lift in this stock, but also Root. I mean, that one really caught my attention yesterday because of the tremendous move it had post earnings. It's had a great year as well, and I think there's an element too of some of these smaller names, small market cap names, not necessarily, pinpointed to insurance or concentrated insurance, but the expectations of lower interest rates, some of them have caught a bit as of late. And I'm going to put SoFi in that same camp as well. And a couple of the other names like Peloton, for instance, that's another one that's still not profitable.
Yeah.
But it's been up higher significantly over the past few months because of the expectations of lower interest rates.
Fair enough. Gave a good bit back today, though. All right, George, thank you very much.